Hello and welcome to this educational edition of Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. And over the holidays, we decided to do a basic education series on option trading. We've called the series Options 101, 102, and 103. I'm going to do a short review today of what was covered in 101 and 102. We first just talked about the vernacular of the marketplace, what an option quote looks like. We then got into two very basic strategies, talked about some of the pitfalls that beginning option traders fall into when they first start trading options. And then today, I think, is probably the most important one. And in my mind, a lot of times I feel like this is where we should start with options. Before we even get into strategies, we should understand why an option is priced the way that the option is priced. And they're much different than pricing stocks. Because of that, we need to learn the dynamics, the time factor, the time premium that comes in to an option contract. And where does that come from? Why does it exist? How does it decay as we approach expiration? So first off, let's run and look at, I put together a few slides today to try to cover the review of the first two shows and get into the actual pricing model. So let's pull that up right now. First off, what are options? We talked about an option being a contract. And actually, back in the day, they used to advertise with contracts and put them actually in a newspaper. And you would sign a physical contract when you traded options. Nowadays, we just need to see a quote. And the important points that are, well, a summary, I guess, the cliff note of that contract is what shows up in the quote. So in our example down here, we have XYZ. We have a January expiration. We have a 70 strike call trading for $3.10. On the ABC put, February expiration, 35 strike put, trading for $1.20. Those are the important things. On most option contracts, when they first were written, they expired on the third Friday of the month. Now we have options that expire basically every week and sometimes even every day. Now, when we get into the strategies here, we talked about the most basic option strategies in options 102. We talked about buying a call and how you're considered long that call option. Once you have bought the call option or bought the put option, you are then considered long that in your account. And in 102, we talked a lot about the difference between buying something that is at the money, in the money, or out of the money. And they're fairly intuitive vocabulary terms. But what that really means is that our strike price, if it is at the money, would be equal to where the stock is at. If our strike price is in the money, if there's intrinsic value in that option contract, well, then we call that an in the money option contract. And if we look at it and the strike price is away from the stock, out of the money, then hence that would be an out of the money option contract. And one of the biggest reasons, or one of the biggest mistakes that beginning option traders like to make is they like to focus on the out of the money option contracts because they are inexpensive. They're cheap. You can buy a lot of them. You sound really good at the cocktail party. I own 100 Apple call options. Who really cares? They're not worth much. When you're buying those out of the money option contracts, you got to be cognizant of the fact that the market needs to get to your strike before that expiration date in order for you to most likely be profitable on the trade. It could try to get there a little earlier if it moves fairly quick, but then the time decay factor comes in inside that option contract. Very important to note. Go back and review a little bit of the 102 if you want to learn a little bit more about that. And then my other suggestion was, well, instead of buying those out of the money option contracts, why don't we do something different? Why don't you consider looking at a covered call option? And a covered call means that we're going to sell an out of the money option contract on a stock that we own. If we do that, once we sell that option, we're considered short that option in the account. If we own the stock, if we own 100 shares of the stock on that option, or if we own 100 shares of stock on that underlying that represents that option contract, well, then we're considered covered. And all we're saying is that we're going to take on an obligation to sell that stock if that stock reaches our strike price. So if we're a seller, we're short, we're going to take on an obligation to sell the underlying stock at that strike price. Very simple, very straightforward. It's a good strategy to get your feet wet and learn about option pricing. Watch how that option moves by just saying, well, I have this stock. If it goes up, I don't mind selling it. All right. Next, the pricing components. Okay, that was a quick review of 101 and 102. Now let's talk about why an option is priced the way that it is. And we mentioned in 101 a little bit about a lot of the synergies between the insurance world and the options world, in that if the insurance world and the vernacular and the options world, if you sell an option contract, you are considered the writer of that contract. If you sell an insurance policy, you are referred to as the underwriter of that insurance policy. If you pay for an option contract, they say that you're paying the options premium. Same thing, you're paying your car insurance. You're paying your car insurance premium. So we're going to talk about car insurance, and we're going to talk about the components that are in a car insurance policy. So first of all, you have the price of the asset. Are you buying a Bentley or a Chevy Cavalier, right? The price of the asset matters. Insurance is going to be a much more expensive on an expensive vehicle as opposed to an inexpensive one. Same with underlying stocks. The more expensive the underlying stock, the more expensive the option contract is going to be. So the price of the asset matters. Now, the deductible, we reference to that in strike price. And the only way that I can really think about planting the seed is not thinking about call options here, which is the first place that a lot of beginning option traders go, is think, I want to buy some out of the money call options, buy a lot of them, and I want to try to get rich using the leverage factor in the option contract. But the fact that options really come, and the pricing of an option comes from the insurance world, the need to protect something. I like to talk about buying a stock, $100 stock, let's say, and buying a put option that will protect me on the downside. So let's say we buy the 95 strike put option. Well, I own 100 shares of stock, much the same that we were talking about in the covered call scenario. And if the market goes down, and let's say it goes from 100 down to 90, I can take the stock that I own, ideally the 100 shares, and put it to somebody at 95. What does that mean? That means I have $5 of risk before my insurance kicks in, my put option, my hedge, my protection. So in that instance, that's the deductible, right? From 100 down to 95, I don't have any protection. From 95 on down, I can take the stock, even if it goes down to 60, and go and put it to somebody. I have to pay for that, right? Just like I do with the car insurance. I have a deductible. I drive the car into the tree. They don't say, oh, you are right, you are a horrible driver, here's your money back. No, they say, we're going to give you a new car in theory, but we're going to take out the deductible. You got the first $500 of risk. That was on you. The rest of the car we had to cover. All right. So that's deductible and strike, price of the asset. Obviously, the more expensive the stock, if it's a $1,000 stock, it could go from 1,000 all the way down to zero. So the risk of buying put options or selling you a put option on a $1,000 stock is much higher than on a $100 stock. Okay, so then time is money, very straightforward. In an insurance contract, you have 6-month, 1-year policy. It's going to cost you more for a 1-year policy than a 6-month policy. With options, you have daily, you have weekly, you have monthly. They'll go out as far. One second, let me grab it. They'll go out as far as 2 years in time. That's approximately 2 years in time, as far as listed option contracts will go out. Now, here's one you might not think of, though, is carry costs. When you pay for your car insurance, when do you pay for it? Do you pay for it at the beginning of the term or at the end of the term? The answer is at the beginning, right? So if you pay for it at the beginning, that means the insurance company has your monies. They can take those monies, they can invest it over the life of the policy. they can earn interest. If they earn really good interest, the concept would be that they give you a discount on your next 6-month policy, which that's the concept, but they usually don't give the money back. But they did actually, Allstate did something very odd over COVID times and actually did give some of the money back because nobody was driving, interesting enough. So it did happen. And obviously, so carry costs, interest rates really affected carry costs. But they have the insurance company, the underwriter has your premium. They are going to they can do whatever they want with those monies as soon as they sell you that policy. Also true in the options contract world. If you buy an option, let's say in our instance, we're talking about a put option, you pay for it up front. The seller of that option contract, the underwriter, actually receives that money and they can earn interest. Now, one thing about the stock market, though, is that stocks pay dividends. And if we're talking about the protected put scenario, right, this stock might pay a dividend. If it pays a dividend, you get the dividend. Okay, so dividends do matter. I very rarely I've never seen Ford where you drive your Ford F-150 around for a month and they say, well, thank you for driving our car. Here's a dividend. Like that doesn't happen, right? In the option or in the markets, in the financial world, that does. Some stocks will pay dividends. So you have interest rates and you have dividends. That affects the carry cost, and that gets factored in to the price of an option contract. All right, level of risk. So in the car insurance world, is the person a Navy SEAL and might just drive the car off the cliff just as a training exercise? Or are you a father of 5 and a teacher and drive around a Chevy Caravan, right? If that is the case, there's a different level of risk between those two individuals. So actuaries try to figure out what that level of risk is. And that's the main difference between the Geico insurance policy, the Allstate insurance policy, or the State Farm insurance policy. How they determine that level of risk and what they're willing to sell you that policy for. That's the biggest factor that is hard to figure out when pricing an option or an insurance contract. In the options world, we'll call that volatility. How volatile is the stock? And how volatile is the stock going to be going forward? So volatility and how volatile the stock has been historically matters. But now we have to figure out going forward over the life of the contract what the implied volatility would be. And then we're implying what the volatility would be over the life of the contract. That is also the difference in the options trading world. It's the hard thing to figure out. But if you come up with that number by looking at what it has done historically, and you put this all into an option pricing model, and you get a premium. We can say price, but the true word, true way to talk about option trading is the price of an option is to call it the premium. In the insurance, you pay your car insurance premium. Everybody says it the same way. Now, one of the big things about pricing models is you can actually figure out the implied volatility. If you and I, we don't want to go on out and we are retail traders and figure out, we don't need to try to come up with what the implied volatility is going to be doing going forward. We have the right to buy. We have the right to sell. We can decide. Market makers down on the trading floor are on the other side of the coin, taking whatever order you send to the floor. If you send a market order to buy an option, they're going to be the ones on the other side selling. A lot of times, other people can get into the mix, and you might trade with another retail customer, but most of the time you're trading with a market maker on the floor or in cyberspace, and they're taking the other side of the trade. They're doing the opposite of what you're doing. So in this instance, if we want to figure out implied volatility, the way we know the price of the option, we know interest rates, we know the expiration date, strike price, and the stock price. Well, all we have to do is just a little bit of math. And if you flip implied volatility around and you put the price of the option contract, you can solve for the implied volatility. And if we know this, we know all these little things, everything can change in here, but implied volatility is something that really drives price. You look at the price, higher the implied volatility, the higher the price that you're going to pay for it. So what can cause implied volatility to go higher? Remember, it's what the marketplace is implying volatility to be over the life of the option contract. Well, news is a big deal. One big news event that you know was going to be coming, it happens quarterly, right? Our earnings drive option prices. So if I see premiums that are inflated or very expensive, usually that is implying that there's some news out there that the market knows about. So you want to go find that. So this is one of the biggest things about pricing options. You think, I just want to go out and buy a call option. I just want to buy a put option. But there are other factors that are involved in the pricing of an option contract, as opposed to just looking at an underlying stock and saying, all right, we see where Apple's trading at today. That's going to be the price. Let's go buy it. In this instance, we want to factor in time to expiration. Options are going to decay as expiration approaches. So what's the sweet spot as far as our expiration date that we're buying? When do we think the stock can reach the target? And how fast do options expire as the expiration approaches? These are things that you want to dig into and take it to the next level. How much does the stock price, when the stock price moves, how much will our option contract move? There are other little components of a pricing model that you can find and get a realistic expectation of how your option contract will move when the underlying stock moves, as expiration approaches, even as interest rates change. In this environment, we've had interest rates change quite a bit. So this actually is a pretty big factor in the option pricing model. All right. Well, I thought I would just throw this up there because the first pricing model was the Black-Scholes formula. And I just wanted to highlight that, yeah, back in the day, these were all of the components: the current stock price, the strike price, risk-free interest rate, dividend yield, time to expiration, rate of return of volatility. And they said, if you give us these things, we can give you a theoretical price of what your option should be worth. And obviously the biggest one is trying to figure out that volatility. But I just wanted to toss this little out here, and I'm going to leave you with that thought. I don't think we ever need to calculate a Black-Scholes model. In other words, we don't need to get into what the letter E is in this model. But it's important to note that, yeah, this is where it came from. A lot of this pricing information came from the insurance marketplace. So that's it for this edition of Options Guide TV. My name is Brian Overby, author of the Options Playbook, every Monday, Wednesday, and Friday at 11 a.m. Eastern Time in the Tradier Hub, hub.tradier.com. Come in, check us out, and hopefully you had a very happy holiday, and we will see you shortly in 2024. Thanks for coming, everyone.